Hi and welcome to the Financial Fox. Today we will be talking about investment in oil and gas in the UK with a London-listed company focused on a high-impact development and production project in the North Sea. The company is Independent Oil and Gas, known as IOG. They recently announced a strategic partnership with CalEnergy Resources. Now, CalEnergy Resources are an oil and gas operating company, but they are also a subsidiary of Berkshire Hathaway Energy. Now, you might have heard of this company and particularly of its founder, which is the famous American business magnate, Mr. Warren Buffett. IOG has also started its operation at the Harvey appraisal well, which was spudded yesterday. So now we are gonna hear everything directly from the CEO, Andrew Hockey, with a complete overview of independent oil and gas. Hi Andy, how are you?
Hi Stefania, good to see you again.
So long time since, since the Sound Energy times.
Indeed, yes.
You have been very busy.
Yeah, I've done a lot of things since then, yes.
So Andrew, you are a veteran in the oil and gas sector, which is quite a unique skills, let's say, among many CEOs that are actually running oil and gas company on small oil and gas company. Now you are running in independent oil and gas, and lots has been going on over the last 3 months. So do you maybe want to give a quick overview of the company?
Absolutely, yes. Veterans are very strong word. It makes me feel very old, Stefania. But anyway, I'll carry on. Yes, IOG is an AIM-listed company on the London Stock Exchange. We are effectively a development and production E&P stock. We want to be a mid-cap gas producer, a material gas producer. We are focused on the UK, and in particular in the UK, we are focused on the southern gas basin of the UK North Sea, relatively benign operating conditions, and we believe a great deal of opportunities still to be exploited there. So what do we have in terms of portfolio? Well, over the last few years, IOG has built a portfolio of gas assets, and within that portfolio we have reserves, we have contingent resources and prospective resources, which total up gross, so gross total, to over 600 billion cubic feet of gas. That's about 100 million barrels of oil equivalent for people who aren't familiar with the numbers. So what we want to do with our portfolio is, well, it's a very simple story. We have a material portfolio of gas assets with gas in the ground that needs to be developed. So it needs wells to be drilled, it needs the gas to be produced through our pipeline. We own our own pipeline, which is unique really for a company of this size, or more or less unique for a company of this size, and then bring that gas through our own infrastructure into the market at Bacton Terminal and then on into the gas market for South East England. We believe that the UK gas market is a good place in which to operate and make returns for our shareholders. The UK now imports 56% of its total daily gas requirements, and only 15 years ago we were completely self-sufficient. So our project, which brings UK gas into the UK market, we think is great for UK PLC. It's certainly great for the Oil and Gas Authority's MER concept, maximum economic recovery, because that's exactly what we're doing. And it's great for our shareholders because we're using what's effectively a recommissioned piece of infrastructure in a relatively easy operating environment, so we're keeping our operating and capital costs as low as we possibly can to preserve margins so we can deliver returns. So that's why this is a really compelling story. I keep saying it, but it's very simple. Gas fields, pipeline, terminal, and into the market. So it's really a very simple story. So IOG was formed about 5 years ago. I joined the company in early 2017, and over the last couple of years, really, what we've done is to move from having our assets predominantly in what we call contingent resources into reserves, and to move towards getting them actually developed and the gas out of the ground and monetized. So what we've done is put together a team here in London, which we'll talk about later, to deliver that project. And then we set about getting ourselves funded to both to deliver the development project, which we call the core project, which will be developed in 2 phases, phase 1 and phase 2, and then also add incremental upside from our appraisal portfolio, for example, Harvey.
Yes,
so that's what we've been doing. And over the last few months, what we've been able to do, a number of the pieces of that jigsaw have really started to fall into place.
So I would like to talk about Harvey particularly because the appraisal well was spud yesterday.
Certainly.
And the chance of success, they are over 60%. So how confident you are the prospective resources, they are going to be contingent resources, and what will be the risk in the drilling?
Okay, let me explain that. It's very simple. So last year what we did with Harvey was we took the three-dimensional seismic that's been acquired over the area and we reprocessed it to get a much better image of the subsurface. Then from our work we then went through a series of pieces of subsurface modelling, and we came up as management with the range of prospective resources for Harvey between 85 billion cubic feet, 129 billion cubic feet mid-case and 199 billion cubic feet top-end, high case prospective resources. What we need to do, however, we need to drill a well on the Harvey structure with two key objectives. We need to confirm the amount of gas that's actually there in the structure and see if our numbers are correct, and we need to confirm that the reservoir can deliver that gas at commercial rates. And those are the objectives of the Harvey well. So the Harvey well has been designed with those objectives in mind. We are using a very carefully chosen set of contractors to make sure that we reduce the execution risk of the well as much as possible.
And also the rig.
And the rig. So starting with the rig, we selected Maersk to provide us with the Maersk Resilient rig. It's a very modern rig. It's only 10 or so years old. It's actually very high specification for the work that we're doing. So it's capable of working efficiently in this relatively shallow water depth, but it could also be working in deeper water depths elsewhere in the world. But it's a very good piece of equipment to do what we want to do. So we have the Maersk Resilient, which is now on location drilling Harvey. We've selected Halliburton as the contractor to provide the bulk of our services to the rig. And as we progress towards having our own drilling department, for this well, we've decided to use Fraser Well Management up in Norwich and Great Yarmouth as our well operator for the well. So we have the right equipment and the right people to drill the well. So that's how we reduce as much as possible the execution risk on the well. The other risk, obviously, is the subsurface risk, which I've talked about. And what we did there was to make sure we had the best possible reprocessing of the seismic data that we could, so we could make the best possible maps and have the clearest view of the subsurface that we could.
And the timeline on Harvey?
The timeline in the success case, we expect the well to take, we've said publicly, the well will take around 2 months in the success case. Yeah.
Okay. So now let's move on your core project and the strategic partnership transaction that you announced with CalEnergy Resources. I mean, they're quite a unique partner. They deploy quite a substantial amount of money. Yeah. You know, you are going to work more with them. Do you maybe want to expand a little bit on what this partnership mean for a company like Independent Oil and Gas?
Sure. Let me first of all just explain a little bit about what the core project is. We've talked about Harvey, and Harvey is incremental appraisal upside in our portfolio. The core in our portfolio works very well and delivers great returns for the company and for its shareholders. So I need to explain just a little bit what the core is. The core is made up of what we call the Blythe Hub, the Vulcan Satellites Hub, and the Goddard discovery, and together they comprise around 410 gross billion cubic feet of gas in 2P reserves and 2C contingent resources. So the core is a material project to get going with. We're wanting to deliver FID on that as soon as we possibly can, but of course we had to get funded. So at the beginning of the year, essentially what we did was to kick off a farm down process with a number of parties, one of which were CalEnergy. And as we worked through that process, it became clear to us that they were the partner that we wanted to work with and bring into the project. They're a partner obviously with great financial strength. They also have great technical strength. So for us, it's been a really great process with them as we've worked through the final due diligence with them in some detail, for them to come on board and effectively give our project a good stamp of credibility so we can move it forward. So we have a good partner in CalEnergy. We know a number of their people from other lives, frankly, and we are very confident we're going to be able to work very well together to deliver the core project, which is what they've currently farmed into. They have an option to farm into Harvey also, which we'll probably come on to in a little while.
So do you want to explain a little bit more about the transaction with CalEnergy?
Yeah, I think it's worth explaining to the viewers a little bit about more, excuse me, a little bit more about the transaction, so we're clear on the structure of it. Very simple, really. CalEnergy has agreed to pay IOG in order to earn 50% of our project, effectively of our core project, has agreed to pay IOG £40 million up front, and then on phase one of the development of the core project, a £60 million carry, so £60 million of our costs effectively will be carried through phase one, and then a £65 million carry through phase two of the core project. In return for that, we do pay back via a royalty in phase one some of the phase one carry, but overall that balances out over time, and what it effectively means is we are funded with the bond that I'm going to talk about in a second. We are funded to get ourselves through phase one and into phase two of the project. So we're effectively funded to first gas and beyond through the project.
Let's talk a little bit about the bond, which will be listed on the Oslo Stock Exchange. And I thought it was quite interesting, to understand why you're going to list it there.
Yeah. So in the E&P sector, it's quite common to use bonds to provide institutional bonds to provide financing for development. And the Norwegian market is really the one that has the best reputation, I think, pretty much globally for being able to deliver that type of financing. So that's where we went when we wanted to look at the debt piece of our funding. Okay. So we work with an investment bank, ABG Sundal Collier, in Norway, and what we're going to do is go out and raise around about £70 million worth of debt via the bond route to sit alongside the money that we'll receive from the carry and the lump sum of the farm down, and that will, as I say, get us all the way through the development. That's
back to the 40 million that CalEnergy is going to pay you in cash. How are you going to deploy this money?
So part of it's quite simple. Part of the 40 million will be used to resolve some of our debt position with London Oil and Gas, and the rest will be used to get the project underway and moving forward, or phase one of the project underway and moving forward.
You mentioned before about the possibility that CalEnergy is going to farm in Harvey as well. What does it depend on?
We agreed with CalEnergy very simply that they could have a very valuable option to farm in and earn 50% of the Harvey licenses and the Harvey structure if it's successful. Essentially, we've just agreed with them that on the fulfilment of certain success criteria, they will come in and exercise their option. If they exercise that option, then they will pay us a further £20 million in cash to come in and earn 50%, and a carry of 95 pence, 95 pence a 1,000 cubic feet over on their share of the gas that's produced ultimately from Harvey once it's developed. That totals up to around that royalty totals up to around £60 million, just over £60 million, if we get the 129 BCF mid-case if Harvey's successful.
And also you sign an area of mutual interest to pursue the, other opportunities with the CalEnergy. Do you maybe want to explain a little bit what type of opportunity would you be looking for?
Obviously, looking around the pipeline area, what we've done with Cal is to sign an area of mutual interest, or an AMI, as we call it in the industries, is to look at other opportunities around the pipeline area that might eventually be tied in. These may be stranded, they may be targets that we might want to pick up through M&A activity, they may be targets that we want to pick up through licensing round activity, but there's certainly a lot more life in the southern gas basin yet, and we wanted to make sure that together with CalEnergy, with us as operator, we'd be able to move forward and actually bring those opportunities that remain in through our pipeline if at all possible, because as we see from the economics we look at for Harvey, the returns are really very strong indeed. once you get the Thames pipeline working and you get phase 1 and phase 2 coming through it, returns from anything incremental that you bring in are really very powerful indeed. For example, project IRRs for the core project are very interesting. They're around 30% IRR, but if you add on Harvey to that mid-case, then you go up into the almost 60% IRR bracket. So any incremental gas that you can bring into the pipeline system really does improve returns for the company and for shareholders, of course.
So you mentioned the pipeline and how important they are. I mean, you are one of the few company that actually own its own pipeline and infrastructure, and they play a key role in the overall project, in all the project of the company.
Yeah. We're certainly one of the few companies of our size, if not the only one, to own our own infrastructure from the fields into the terminal, and we now own, of course, the Thames reception facility inside the Bacton terminal, and the intent there is to refurbish that and use that to bring our gas into the market through the Perenco part of the Bacton terminal. So it's tremendously important. The pipeline had been decommissioned. It was used by the Thames partnership to develop and monetize the Thames cluster of fields, which are just to the east of where we are. When the Thames partnership decommissioned the pipeline in 2015, we saw an opportunity to buy it and to therefore be able to liberate gas around us, for example, our Vulcan Satellites hub, which previously might have been stranded and not been able to find an easy export route into market. So the Thames pipeline allows us to do that. It allows us to get gas that otherwise wouldn't have found an export route into the market through our own pipeline. And we, of course, have control over the whole system from the reservoir all the way into the terminal. It also, as well as being able to deliver our current project and hopefully deliver Harvey in the success case as well, it also allows us to look at M&A opportunities around us in terms of other operators who may have gas that we want to bring in through the system, and indeed potential third-party tariffing opportunities as well. So it really brings us a lot of flexibility in what we can do in actually adding to and improving the returns that we're making from our core project.
In terms of offshore drilling operation versus onshore drilling operation, we know there is a higher risk, there are more costs involved. Do you think in the small cap space there is still these type of offshore operation are still attractive to investors?
Yes, we are a compelling proposition for investors, certainly. Why do I think that? Because you've seen really a change in ownership of assets in the North Sea over the last few years, with many of the majors moving away and with management teams coming in smaller units, able to devote more management time and expertise to assets. So I have a team that I built here in London that's very much a gas-focused Southern North Sea team. So I think that makes us a good proposition because we know what we're doing and the right assets are in the right hands, and we're able to focus on what we know and do best and keep costs down, both operating costs and capital costs, keep costs down through really good management focus. So I think, yes, there really are still a number of good investment opportunities in the Southern Gas Basin to be had. We hope to prove that to you over the next few years.
And you are minimizing the risk, choosing the right partner as well.
Yeah, so as I talked a little earlier on about execution risk and about subsurface risk, I think if we talk about subsurface risk, first of all, this is a basin that's well understood. Certainly the part of it that we are working in is well understood. It's been worked on since the mid-1960s. It's been produced from since 1967. It's where the first North Sea gas came from into the system. So the subsurface we understand and we know what we're doing. And then also there's execution risk. Now in terms of execution risk, as an area of the North Sea, the Southern North Sea is probably the most benign to operate in. Water depths are relatively shallow, therefore decommissioning liabilities are relatively low. You can use jack-up rigs, so it's fairly simple to operate. You're not far from shore at Great Yarmouth and the east coast of England. So you have many things in your favour in terms of minimising the execution risk of actually getting things done as well in the Southern Gas Basin.
Let's talk a little bit about the team that you built.
Sure.
You joined Independent Oil and Gas, you said, in 2017, and over years you got more involved and also you brought in the right people. Do you maybe want to tell us something a little bit about your team?
Yeah, so I think think we should give credit to the previous management team and the work that they did on bringing in the pipeline and getting the portfolio together. And what I've then tried to do is build on that very much and put a team together that is gas-based and focused. So, for example, our Chief Operating Officer, Mark Hughes, has a great deal of experience with GDF, with RWE, with INEOS in the basin here. He was responsible for the developments of the Clipper South field back in 2010 to 2012, and the Brea field more or less immediately thereafter. So he really understands the engineering challenges in the basin that need to be addressed, and many of the commercial challenges also need to be addressed. So there's an example. Our project team that we have here in London are all of a similar vein, or all in a similar vein. Nearly all of them have really good, lengthy Southern Gas Basin operating experience. Our technical director, Doug Fennick, used to be Arco's gas basin manager for the area that we, IOG, are now operating in. So we built a management team and a technical team that is really able to address this part of the North Sea and understands it. In parallel with that, there have been a number of changes on the board over the last couple of years, and we've now got to a fairly settled position where we have Fiona McCauley, who's very experienced, been with Echo Energy, a number of other AIM-listed, with Rockhopper, a number of other AIM-listed companies, so she really understands both the technical side and the business side. We brought in Asa Ikeheimonen. Asa is Ganel's CFO, and he's effectively the senior independent director on our board, with a great deal of, obviously, financial experience, and he chairs the audit committee. And most recently, we brought in Neil Hawkins. Neil is ex-ConocoPhillips. He ran the Britannia gas project, so again, he really understands gas in the North Sea, has an engineering background, which gives my team the challenge that they need at board level to make sure we're running the project in the right way. And so those three non-execs really are create a very high quality challenge to the executive team, which on the board at least comprises myself and Mark Hughes. And then we also have James Chance, our CFO, who's ex-Standard Chartered banker and has been with IOG some time now, so understands the company very well. And Rupert Newell, who we've brought in as head of corporate finance, and Rupert's been really helpful in all of the financing that we've done through the course of the last few months, and in bringing in the CalEnergy farm down.
Okay, Andy, now that we announce the spud of Harvey, what will be the next catalyst event the investors should look for?
So obviously Harvey results coming up, but then looking ahead, I think the next really exciting thing is us being able to complete the farm out and go to final investment decision. Along with that, we need to obviously complete the bond financing as well, alongside the completion of the farm out. That then gets us to a position where we can take final investment decision, we can move forward to field development plan approval and kick the project off for the development of the core project, kick off phase one. And we think it's about 20 months, around about 20 months from when we take FID to first gas. So there's a lot coming up in the next few months in terms of news flow to look for.
Okay, lots to look forward to.
Indeed, we will be with CalEnergy. We'll be looking at the 32nd offshore licensing round with a focus on the gas basin again as well, in terms of where we may want to add to the portfolio where it's appropriate.
Okay, and the last question that I obviously have to ask, because was actually an inquiry from one of the shareholders, is about the convertible loan note. A few investors are obviously concerned, and they would like to know how you are dealing with it to preserve shareholder value.
Certainly, and you can understand the concern, but I can assure investors that we are actually addressing this right now, and it's part of actually the farm out process, the way that we're going to address it, and we do expect to be able to update the market on the steps that we're taking in the next few weeks.
Okay, thank you so much.
Thank you, Stefania.
And it was a pleasure to have you here.
And to talk to you, thank you.
I hope to have you soon with more news as the company progress.
Very good, thank you very much.
Thanks. This is everything from the Financial Fox. I see you next time.